Happy Thursday. Hello, everyone, and welcome to Session 5 of Schwab Coaching's New to Investing series. My name is Alex Coffey. I'm a senior trading and derivative strategist for Charles Schwab. I'm also the host of Next Gen Investing on the Schwab Network. For those who are unaware or aren't familiar with Schwab Network, it is a separate but affiliated subsidiary of the Charles Schwab Corporation, produced by Charles Schwab Media Productions. I should also mention at this time that this will be a moderated discussion for those who are watching live on YouTube. My colleague Michael Fairborn will be in the YouTube chat to answer any questions you may have along the way. The goal of today's session will be to discuss diversification, what it means, why it matters, and how new investors can use it to think about risk in a more balanced way. Before we get into the presentation, there are a few housekeeping items that we must attend to. Today's discussion is for general, informational, and educational purposes only. Nothing we discuss today should be considered investment advice. Investing involves risk, including the possible loss of principal, and it's important to remember that diversification does not ensure a profit or protect against any losses in declining markets. All right, we'll go ahead and do a quick kind of recap series overview for those who haven't been along for the journey thus far. But as I mentioned at the very beginning, this is an 8-part series that is designed to take new investors from the basics to building long-term investing habits. So far we started by really highlighting the importance of starting early. One of the things we talked about was the power of compound interest and compounding. And the analogy we've used along the way is if you envision rolling a ball of snow down a hill, if it's a snowy hill, it'll pick up more and more snow along the way. That's sort of the idea of investing, in which you take a little bit of risk or a lot of bit of risk, whatever makes sense for you in your portfolio. But over time, the potential rewards are that your beginning money makes a little bit of money, which makes a little bit more money, and that power of compounding over time. We then, in our second session, we really took a step backwards and defined sort of what it means to be involved in the stock market, what the stock market is. We discussed sort of the differences between saving and investing and the goals. We then started to introduce, where things like this can actually happen, by looking at the schwab.com webpage. And we'll do a little bit of that towards the end of today as well. And then, of course, last week, we picked up where we left off, continued sort of going through that process online, and kind of demonstrated what it would look like to actually, potentially put a trade in or an investment in on the platform if that was what you decided you wanted to do. Today's going to build on those foundations. Because once you start finding ideas and ultimately investing in things that you want to be invested in, the real logical question is, and hopefully for many this would be before you start clicking the button, it would be how much do you want to depend on any one stock, any one sector or idea. And that's where this concept and idea of diversification really comes into play. And so we'll keep today relatively simple. To begin, we've already sort of framed, where this session ultimately hopes to fit within this series. And in a few moments, we'll begin to talk about some of these basics of diversification. And the reason we're going to do this is, some of the ways that investors choose to diversify differs. So you can do this by investing in different asset classes, and we'll talk about some of those. So this could mean, choosing to invest in something like, stocks versus bonds, or even gold, or other things. Other ways to diversify can be within certain asset classes. So things like stocks, there's, a lot of different options, lots of different publicly traded companies that are all different, and they work in different industries and different sectors, and you can look at ways to do that there. We'll finish by looking at a couple of different individual stock examples on the platform, not as recommendations, and for those who've been along for the journey, they may recognize the names that we're going to use as we've discussed them in previous sessions as well. But we're going to do this to show you how different companies can kind of bring different types of exposures, different types of return profiles, and of course, different types of risks. So as we move into sort of the beginnings of defining what some of these concepts are when it comes to diversification, I think it's really important to start with, what is diversification? It's a big word, but the idea is relatively simple, and the idea is not to put all of the money in one place. So not putting all the eggs in one basket, to use that kind of old phrase. It means spreading these investments and the capital that you're using as investment capital across different assets, different sectors, different industries, and even different parts of the world potentially. The goal is not to remove risk, because remember, we've already talked about the idea of taking a little bit of risk because it's the other side of the potential reward coin. And we'll talk about that in a later session more in depth, but the idea being, in exchange for risk, we have the possibility to actually see some reward. And so we're not going to look to remove risk completely, and one that's also not really possible within investing, but the goal is to reduce the risk that one investment or one stock or one company or one part of the market has too much control over our financial future. And a simple way to think about this is, you don't necessarily need, in a diversified portfolio, every single investment to work perfectly. You want a portfolio that can hold together even when a few things don't. And so as we start, kind of thinking about this, it's important to start thinking about the different types of investment choices that you may have. And this is by no means an exhaustive list, but these are some of the, kind of high level, ways to think about things. And so we've already defined stocks, but in order to kind of get into building a diversified portfolio, we want to understand some of these, pretty essential building blocks for many. So we've talked about stocks and how they represent ownership in a company. That company does well, the value of that ownership can grow. But stocks also move around maybe a little bit more, especially stocks that are in maybe more of a growth-oriented phase. And that movement is, in the world of trading and investing, it's referred to as volatility. And that volatility is both your risk, but it's also your opportunity. Now, depending on where you are in life and your investment journey and how much money you want to set aside and your risk profile, that volatility can be a bit scary. It could be something that you also want to use other assets to diversify your portfolio and maybe change some of those return profiles and potentials. Bonds are a bit different. So bonds, you're generally, and if we're really breaking it down, you're lending money to a company or a government, and in return, you would seek, interest payments. So you're the lender in this case, and how it really would work would, you buy a bond product or, a bond paper, and you would get potentially coupon payments on, different cadence times. But the idea being, in the end, if it's a creditor that can be trusted and is secure, they ultimately will pay back that full principal, but along the way you were paying interest, similar to what we would do the other way around if you were borrowing to buy something. And so we flip it upside down when you're investing in fixed income or bonds. Now, the third is cash equivalents. So this is a little bit more in sort of that savings world. And so these are things that are a little bit more liquid, maybe a little bit more short term, and they're generally lower risk. And maybe you would have some cash equivalents set to the side for emergency purposes. Maybe you felt, for whatever reason, that it just wasn't quite the time to make your investments. But depending on your risk profile as well, cash equivalents can make sense as a diversification tool as well. So again, to kind of start to summarize these things and put them together, if we think of these, and again, not an exhaustive list, but as building blocks for a diversified portfolio. Diversification is thinking about sort of putting the blocks together and building a portfolio. And so as we start to think about other ways that can be, other things and processes to make this, potentially easier, is that investors don't have to build diversification and diversified portfolios one stock at a time. And so while we've talked about ways in our last, session to potentially invest in fractional ownership of companies, and you can make the building blocks a little bit smaller, and you can still do that. There are other ways to do this, a little bit more efficiently. And some of the common ways to diversify include investing in something called mutual funds or ETFs. And then of course the final one is, actually going through that process and building something out yourself. And you could actually do that using some of those fund products as well. Now, for many new investors, funds can be a helpful starting point, just simply because one investment can provide so many different exposures into many different holdings. And that doesn't mean that every single fund makes sense for everyone, but it does make things just a little bit easier to ultimately achieve. And so let's start with talking a little bit more about ETFs, because in the world of trading especially, but also investing, ETFs have really become quite prominent, especially in portfolio construction. ETF stands for Exchange Traded Fund, and the key idea is that an ETF trades on an exchange similar to a stock, but under the hood, it actually is invested in several different things. And so common ones might be baskets of stocks, like an index, might seek to track an index. It can be exposures into bonds or commodities or things that are a little bit different. And the idea being that the fund would define in its what they call prospectus what the goals of that fund are and how it seeks to accomplish that. So instead of investing directly in, like we've talked about the last couple weeks, maybe a company like Apple or Nike, you would potentially look at an ETF, and it can give you exposure to dozens, hundreds, and even thousands of different holdings. And that's why it can be a useful tool for diversification, as it can make that process a little bit less cumbersome and also a little bit more accessible, if we're being fair, especially for someone who's maybe newer to investing, maybe doesn't have the same amount of capital as someone who's a little bit more seasoned. Another reason that ETFs are quite common is that they have ETFs in many cases that are tied to different parts of the market. And so this can be, and as I mentioned, something like one that tracks a major U.S. index. So that could be the S&P 500, it could be the NASDAQ 100, it could be the Dow Jones Industrial Average, it could be the Russell 2000. And there are several different, products that seek to accomplish tracking of those particular major markets. Also, there's some that are a little bit more granular. So they may look at a industry group or a sector, maybe technology, for example, or financials, and that gives you a chance to build a portfolio that's a little bit more skewed to one area or the next without having to choose the winning company or group of companies on your own. Now, and there's also, of course, international ETFs too, and so while the U.S. has its own stock exchange that places like Charles Schwab give access to, there are also international stock exchanges that can be a little bit more difficult for Americans in particular to have access to. And so some of these different country investing ETFs make it a little bit more accessible for sure if you decided that was a path you wanted to go down. So again, this is sort of where this idea of top-down thinking can come in, where rather than thinking about just specifically a company, again, we'll use Apple for an example. Oh, I like the iPhone, I want to invest in Apple, for example, not a recommendation. You can start thinking about, okay, companies like Apple, okay, that's a technology company. Maybe I would look to a different way to ask that question. How can I get exposure to companies like Apple? And maybe something like a technology ETF in that example could make sense. Now, there are risks, of course, with any investment, but ETFs, while they're useful, they're certainly not risk-free. One of the major risks, of course, is just general market risk. If the assets that are held in that fund go down, the ETF, of course, can and maybe is likely to go down. There's also tracking errors. Now, these investment companies that are putting these funds together, of course, collect fees on these products. That's one of the reasons that they're incentivized to do that. There's also transaction costs and other dynamics that are unique to each fund that can cause some sort of mismatches at times, and it's important to understand those risks and read about the fund when you're going through your homework process and thinking about an investment. Also, it should mention, of course, that liquidity is important, and the idea of liquidity is just how easy is it for me to buy and sell this? How much demand and supply is available of this particular asset or fund in this case? And while many of them are very, very liquid, and it can be pretty seamless, especially for a smaller investor to get in and out, some are a little bit more niche, and they might not be as frequently traded. And that can create a little bit of illiquidity. And in the world of trading, we would refer to this as wide bid-ask spread. So the market is essentially, people who are bidding and hoping to buy something at a price, and others who are offering to sell. And when those come together, that makes a trade. And if it's not as commonly traded, the difference between the bidders and those who are offering to sell can be wider and wider. And that, of course, can lead to slippage. And then, of course, if an ETF doesn't have, a lot of activity or interest, there's also just risk that the fund manager may elect to just to close down that ETF. Now, there would be, ways that would ultimately be handled, but it would, again, be so unique that it's hard to go through that specifically at this moment. And then finally, there's general risks, of course, that are just, and this is really this idea of concentration. There's risks that, you're still not diversified even if you've used a fund. If it's a very specific fund, if it's a technology fund, for example, and technology struggles, well, maybe all technology stocks struggle, and that fund, of course, would still not really provide that diversification that you were hoping for, because it's not like it was an Apple specific story. It was just generally technology wasn't doing great, and your, of course, portfolio could still go down. So all in all, I guess to kind of tie this together, ETFs can help with diversification, but investors still need to understand what the ETF ultimately owns. All right, quickly we'll pull up our platform here, and we'll go through, and we'll start on our same web page here, which is the watch list page. For those who are maybe following along at home and wanting to click to here, it's research and then watch list. So we'll go ahead and reload that, and it populates for us, in this case, to our new to investing watch list, which contains Apple and Nike. And so if we're making this more practical and we're looking at a couple of these different names, maybe we'll start by clicking on Apple, and we'll pull it up, and we can see the time frame for today is this. We can also click it one more time, and it'll load up the screen here and give us a little bit more real estate, and we'll scroll down and click show more on our chart just to make this take up our full page. And so this is the last 1 year's worth of performance for Apple, and we're just going to use rounding here just to make this concept a little bit easier. So let's say that Apple started at 200, started at about 210 a year ago, and it got up to 300. Now it's a little bit more than that. It's closer, it looks like, in real time to 330, but let's call it 300 to make the math a little bit easier for me. So that would be a 50% return, right? It went from 200 to 300. And so if I had $1,000 invested in Apple over that time, and it went from 200 to 300, my $1,000 on paper would be worth $1,500. Now, that would be great if that was my only investment, but as we flip back to our screen here, remember we had Nike as another one of our options, or choices, I should say. We click show more on the chart here, and again, pull up the 1 year chart. Well, this stock started around 70, and is currently trading around 44. Well, let's make this easier for me on math as well. Let's say it started at 80 and it went down to 40, so it lost half. So in this case, if you had $1,000 and it lost half, it would be worth on paper now $500. If this was the only choice that we had, well, we would have lost $500. Now, together, using our example, it would be break even. Now, in real terms, based off the actual prices, 73 to 44 is a little bit less than losing half, and Apple, of course, was up a little bit more than 50%. So if a portfolio even just contained just those two names, it would be slightly positive. But the idea here is starting to think about things as more than just one company at a time. And also, as you branch out to maybe a second company or even look at some of these funds, to start thinking about them in a way that asks the question, how are they different? Are they different enough? Is adding this investment changing how my portfolio might react to different stories and news and things of that nature? And so in this case, Apple makes a consumer product, but it's a technology product and several technology products. Or Nike, it makes a little bit more, in the apparel space, footwear. Both rely on the U.S. and international consumer, but both, of course, are quite different in the types of products that they make. All in all, though, as we sort of wrap these ideas up, and when we come back to our slides here, there are really three big takeaways for today. First off, diversification means not letting one sector, one stock, one idea decide your entire investing outcome. Secondly, ETFs and mutual funds can make diversification much, much more accessible because one investment can provide exposure to many different things. And thirdly, diversification helps to manage risk, but it does not look to remove it completely. Next session, we'll build on this by talking about thinking through and maybe even walking through what building a first portfolio could look like. We thank you, as always, for tuning in and joining us here for session 5. We'll see you next time.